Hey traders, this is Blake Morrow with Traders Summit. With me today, I have Mr. Ted Oakley, managing partner and founder of Oxbow Advisors. Great to have you here, Ted.
Thanks, Blake. Glad to be here.
You know, I've listened to a lot of interviews with you, and I love the fact that you can cover a broad spectrum of topics, and there's there's no shortage of topics to talk about right now. But let's start with the big one, the big kahuna, if you will. Let's talk about equities and your feelings in equities right now, because we're faced today with some pretty big earnings from, later today, we'll have them from Apple and Amazon. And, with equity markets, the S&P kind of tilting towards that 4,000 level. How do you feel about equities where they're currently at in the current state of the markets as a whole?
Well, Blake, they are, most of these markets are right down on their lows of early March. We always felt like they would break that eventually. And what happens in these bear markets is, and it's interesting because most of the people around, a lot of the people have probably only been around the last 13 or 14 years. So they've never seen a real true lengthy bear market. Right, and in those kinds of markets, what happens is it just keeps pulling people in every time it breaks down because they think that's the low, okay? When it keeps on going, and we think they'll break those lows that we had in early March. We're right down on them right now. The NASDAQ actually did break it, but the S&P and the Dow are right behind it. So what we're looking for is, we think that really May and June will be pretty tough months. It wouldn't surprise us for the market to bottom sometime between this period and say September or something for the year. But, a lot of these second years of presidential years are low years. If you look back, at 02 and prior to that, if you go back to 82, there's a lot of times we've had some pretty poor markets in those periods, but that's what we're looking for. I know we're probably against the grain because everybody keeps buying the dip, but the dips, that's not working right now. It comes back and takes them to a lower low.
Well, I guess you talk about buying the dip. We talk maybe a little bit of micro inside of the bigger macro picture. Even today's GDP numbers, they came in worse than expected. I think most traders came out and, as you rightly pointed out, they come in, buy the dip because they think that the Fed's going to come save them this time around, and then they ended up getting smacked down by the market open. So, in this type of environment, when you don't have a lot of traders, asset managers, portfolio managers that have really have the experience that somebody like yourself has had, you think that's going to have a very negative effect on the market from a positioning standpoint?
Well, it's something like this, and I'll tell you, if you look at really all of the 70s up until 1980, late 82, when the market actually changed and the interest rates started coming down, you had to know where you were in those markets, because every couple of years back and forth, you would be up or down 20%, 30%, but you never went to new highs. And I think we could be going into a period like that where basically, if you look at over a 5-year period, say, equities will not return a lot. Let's just say the averages might return 5%. Unless you know where you are at times, and you can have liquidity when you need it and put it in when it's lower, take it out when it's higher, that sort of thing. Well, see, the people that are around on this period I'm talking about since 2008, basically, have been in this buy and hold, just put it in and forget about it, like plug and play. Yeah. And we just don't think that will work the next 5 to 7 years.
So we're going to be probably in a more range type of environment where I would have to say, just based on your comments, do you think that because we've had low rates at such a remarkable level for so many years, that it's built up this excess capacity where the market's got to work it off? Is that a good summation of what you're feeling right now?
Well, Blake, you have to try to get back to normalization of returns. And when you look at it, see, at the highs in November, we were 2 or 3 standard deviations above the norm. Now, that is, when you get 2 or 3 sigma above that, that just tells you that you're so far out of bounds that you have to have a fairly significant pullback just to get in the range. And so that doesn't mean to go undervalued. I mean, I'm just saying come back to a normalization. If you want to get undervalued, then you really have some trouble. And so we think, markets over the years, I know people don't believe this, but, since they've been in existence here in this country, late 1880s, they come back to the norm eventually. It may take a while, but they get there.
The rubber band stretching a little bit. Well, let's shift gears just a little bit, Ted. Regarding, I want to go into housing a little bit, because obviously we've been in a period where low rates have been the norm for most people, and rates have been rising. It's really starting to impact, housing in a sense. And you live in an area in South Texas where you've got the Sun Belt region, if you will, myself included, living in the Phoenix metro area, where housing has been really kind of out of control, to say the least. But we're seeing this, housing markets globally, because of COVID, really move higher. How do you feel about housing at current levels with rates moving higher?
Here's the problem you're having now. If you go back 18 months ago and you were roughly at 2.6%, 30-year mortgage, and yesterday you were 5.29.
Yeah.
Then all of a sudden, you've got a doubling of the payment effectively.
That was quickly.
Yeah, real quickly.
Yeah.
Secondly, you had to deal with the prices over the last 2 years, which are exorbitant. But thirdly, and this is something I think people miss, and I'm sure, I don't know if your taxes have come out yet in Scottsdale, but most places they have. And what they're showing is all these municipalities are really raising the valuation. So all of a sudden, you've got all three of those things working against you, and your taxes are just going crazy. I mean, the taxes I'd say in Austin and Dallas are probably up on the average 35%. And, if you're homesteaded, it's a little better. But here's what the real problem is. It got well above where it should be. My friend Jimmy Stack at Stack Research has a graph of the housing. If you look at housing residential versus the CPI and consumer prices, it's 44% above the line. It's never been that high. And that just means it's gone up so much above the normal, even the inflation rate now, that people are going to be hung up. And I say this from this standpoint. If you look at mortgages today, 70% of the mortgages are below 4%. So if you think from a mobility standpoint, if I'm going to be moving to another home, okay, I'm number one, I have a great mortgage now. Let's say it's at 2 3/4 or 3, and now I've got to go to 5 1/4. Then all of a sudden it changes my ability to either move from that home and go to another home, even if it's a lateral move. And so I think what happens here is people don't realize, but this train is coming at you on the residential. I own, I'm invested in private banks, and so I'm on boards, and so I see what goes on with all these builders, and they basically just build until they hit the wall, and I don't think they see it right now, but we see it. And actually, if you look at Redfin, just came out with some numbers last night. For the first time in the last 3 years, we're down 4 to 5% year on year on sales. So it started. I think it'll keep on going, though.
So let me ask you, just kind of staying on the housing topic, when you have some of the people point their finger at the lack or low inventory, and a lot of builders have been reluctant to really move forward aggressively following the GFC, if you will, or the housing crisis that we lived through a decade ago. And here we are now because of COVID pressures and a lot of work from home that inventories are really low. So, builders are scrambling around to build up that inventory. Do you think that's going to come to a head soon as well?
Their biggest problem, Blake, has been is finding land. You got to find lots as a builder. That's your bread and butter. And
Sure.
Once you get lots, then you can go from there. But what's happening on those is a couple of things have been going on. One of the things they're not in inventory is because they're holding these homes back. Like in the last 2 years, if you started a home, somebody said, I'll take it, especially in the last 12 months, I should say, and I'll take that home. But all of a sudden, inflation is kicking all of those material goods. So when the builder gets to the end of the line, they're not making near as much money if they're making anything on what. So they held them back and said, we're not going to contract it until we probably get it framed up or maybe get a roof on it or something. And then we'll contract it. Those things don't go into the inventory at that point. But the second part is that market can dry up a lot. Now, I've talked to a couple of really big builders in Texas that just said, I'm talking the last 3 or 4 weeks, and they say that basically when they had maybe 20 people looking at new houses, now they have 1 or 2. So it starts like that, and then all of a sudden you don't have any. And I think that's where we're headed here right now. It's a slow process, but it catches on over time. The stock market is a really good, I tell bankers this all the time. Stock market's a real good indicator of real estate, and it front runs it. And so if you have it coming down, which we think it will, you think about the average person out here that has 401k and they had a lot of home equity and everything. It will be depressing for them to have the market down and their home price come back off.
That's definitely a double whammy for a lot of people. And you said something twice in your last just your last commentary about inflationary pressures. So maybe we can kind of shift over there, because if you're taking the consumer, they can't move, and if they're forced to move, they're forced to take on a 5.5-6% mortgage rate or whatever it is. What they can afford, and then you got taxes on top of that, and then you've got high prices. How do you feel about inflation and how that's going to, I guess it's a two-pronged question. How's that going to play out in the near term for the consumer? But in the long term, do you feel that these inflationary pressures that we're feeling globally are going to be persistent?
Well, if you look at it, Blake, in the primary part of the housing market, forget the people that are paying $3 or $4 or $5 million cash for a home because they've got the money. Okay, yeah. So for them to overpay really doesn't make any difference. I'm talking about the bread and butter real estate side. And what happens on that is that they go down and I'll just give an example. I'm trying to get a new refrigerator that I keep in one of the garages inside the home. Well, it takes you forever to get it because you can't get it right now. And I'd be willing to pay just about anything to get it just because I need one.
You're right.
But the thing about it is that that will probably slow down as well. And I think the big thing for people that manage money is this is what they've got to determine the next 12 months. They've got to determine if this move in inflation that we've had is really going to stick, or is it going to, was it just a one-time, one-off sort of thing? I actually think that's the thing you'll have to decide, because let's say that it slows the economy down, you even go into a recession. Well, obviously the rates are going to come down at that point. And rates have never gone up in a recession, they go down. So let's say they come back, but they don't go way back where they were. As a money manager, you're going to have to decide at that point whether you think that's going to be a trend, or you're going to go back into the inflationary levels of, what we expect. That will separate probably the wheat from the chaff, I should say, in money management, because you're going to have to make that decision somewhere.
Well, and I actually want to come back to that topic, because I'd love to know and pick your brain a little bit on where those places are going to be from an investment point of view, because I know you deal with a lot of high wealth individuals. But before I go into that, I wanted to pick your brain a little bit about, this craze that we've seen in recent years about, whether it's, cryptos, NFTs. I mean, it seems like a parking spot for a lot of wealthy investors, which I'm sure your clients, pick your brain all the time about what to do in the crypto space, if you will. How do you feel about cryptos in general? The technology behind it, and then the extensions of that, where you're talking about NFTs and all those alternative investments. Where do you stand on those?
Well, here's where I am, and I'm not. By the way, I'm not. I know I've gotten some comments from people that I'm out of step, or I don't. But I've been in these areas before investing, because I've been around longer than most people, where they think it's a new paradigm. There's something different. Now, some good things come out of that. And one of the good things I think comes out of all of this is probably the really sophisticated blockchain technology to use in a lot of things. I think that's where it really is. And if you want to look at DeFi and that kind of thing, that's where it goes. Now, as far as crypto goes itself, it will not surprise me out of the 9,600, 10,000 cryptos we have, if most of those don't lose everything or lose a lot, I should say. And if you break down 100 years of people's ages from 0 to 100, if you break it at 50, below 50 going toward 18, it gets increasingly higher and higher how much crypto they own. Above 50 going toward 100, it gets less and less as they get older. So what I'm trying to say is it's really, if you look at it, it's a Gen Z, Gen X, millennial type. That's where you get a lot of ownership in it. Okay. I feel for them in this particular realm. They're not thinking about cash flow. And this is also a group of people now, you have to realize they haven't had anything go wrong in the last 14 or 15 years. I mean, everything's okay. So they don't realize that all of that stuff, much like the tech, I saw so many high-flying techs in 98, 99. We knew they would go to zero, and they did. But you couldn't convince anybody at the time. And I'm sure there's a certain number, the big ones will do okay, you know? They'll do okay. I really do believe that part of the crypto market will do. But I think more than that, I think the decentralized finance game with blockchain, I think that's really what comes out of this. That'll be unusual, but interesting to see what happens.
So what happens with those people that are, like, let's say their purchases of these big NFT, some of these high ticket items that we see them in the headlines, whether it's on your Bloomberg terminal or whether it's, on Reuters, and you see like these staggering numbers. What happens to those assets, if you want to call them?
Well, I don't know if you saw this last week or week before, but Sotheby's had, they were doing the big auction on, they had 100 and something of the faces. I can't tell you exactly what they're all about. They weren't the gorillas, they were something else. But nobody showed up. Nobody with any real money showed up. They actually called it off, because what happened is they only had people that are like, the crypto followers and that sort of thing that are around. And, there's still big people that hold on to Cabbage Patch dolls and Beanie Babies. I mean, you can get into that stuff and still have it hanging around. You've got followers no matter what. But I'm just saying that I think that it'll go a different direction. It's almost like the tech stocks of 98 and 99. I don't know if you remember CMGI, but they were supposed to be the Google of the world. All right. Well, they went away. they went down about 95%. You probably remember the New England Patriots named the stadium after them and all of that.
That's always the indicator, isn't it, Ted?
Yeah. So you go out on these stadiums, they just, we've had a couple of stadiums just got named after crypto. Well, it'll be interesting to see where they are in 5 or 6 years. Biggest thing I would come back on is this, though. Every great investment in the world, somewhere along the line, has to have cash flow generation, something. Either, that's the only thing that doesn't do that really is gold, but the others, real estate, private business, oil and gas, stocks, bond, it's all cash flow. And,
so with that being said, you going back to crypto and, cash flow. So I'm assuming, and this is just an assumption because I want to hear your thoughts on this, that crypto, once viewed as possibly a replacement for the dollar, but we all can look and say, well, I don't want my dollar moving 8% a day or whatever the case may be. So maybe if it's not the dollar, is it a replacement for gold? Is the reality, or is this a reality where investors are now saying, I don't want to own a rock, shiny yellow rock. I'd rather just own a digital asset. Is that a real thing? And do you think that that's the place for maybe Bitcoin, if you will? Let's just strip out everything else. Bitcoin, is that the place for Bitcoin 10, 20 years from now? What are your thoughts there?
I wouldn't say that. I just think the coins are too volatile to be, a currency replacement. Now, I'm not saying a stable coin or something like that couldn't do that. I mean, there's other ways to do it. And I think that's one of the problems with the sovereign countries trying to, create a digital currency in what they do. However, I will tell you, if you look around the world right now, you look at China and Russia and all these places, Australia, these places, all of a sudden, they're really tying a lot of what they do to hard assets, which includes oil and gold and commodities, different things that they have. And if we are going back, and that's what I was saying earlier, if we're going back into a hard asset world the next, say, 5 to 10 years, crypto is not going to work. I mean, they don't have a hedge on that, other than the fact that somebody else has got to show up to buy it from you. And I think the NFT market is just is sort of a disaster to me. But I'm sure there's some of them that are okay. But again, I think a lot of people in that market come out of the Pac-Man world, so to speak, and they grew up doing that kind of thing, and they don't see it. But I think that's where we're headed. And you can call me an old codger, whatever you want to call me, but I know we've always gone back to investing norms over time.
Yeah, that makes a lot of sense. So, to wrap things up with you, Ted, I'm hearing bear market, hard assets. Where do we as traders? What's the best way for us to take advantage of? Let's just say in the next 6 to 12 months. From a defensive posture, it seems like, where's the best place we should be expressing our investment views, our trading views right now?
Well, one of the things happening now, Blake, that wasn't happening, even a year ago, is that you can make some money now on 3 months, 6 months, 9 months U.S. Treasuries or 1 year, and for a holding spot. Now, I'm not saying that's obviously it's not a long-term investment, but for a holding spot, we think the pricing will be better off in the future than it is now. And I'm talking about the future of 22. And if it is, then there's not many things you're going to own here that are going to go against trend. And by that, I mean, most people, I always tell everybody in our research meetings, it really doesn't make any difference what we think fundamentally about a company. A lot of times, if we're in a bear market, macro-wise, they all go down. Even the gold miners. Now they come back faster, and we own the gold miners, but they'll come back faster. But right now, I think if you came in here with 100% cash right now, which we get a lot of money in, we're taking probably 75% of it right now and holding it back short term. We do think even the long-term bonds will rally some as the market breaks down. So, but that's not where we're going to put a ton of money. We would put maybe 7-8%, but. And then the balance of it, we'll use, we like the energies that have cash flow. So obviously we like the oil and gas pipelines, that type of thing. We like the gold miners. We like real estate investment trusts if you buy them right. They really, in their own way, they can be an inflation hedge too. And so we're concentrated on that. And then the market that's really opened up big for us in the last 2 or 3 weeks is if you look at these too big to fail banks, I'm going to take the top 12. They have some great preferreds out there. And I'm talking about these preferreds are yielding 6 to 7% that are basically only taxed at 20% right now. But so they've opened up. So, all of a sudden, well, if I think the market's only going to do 5% the next, say, 5 years, but I can get 6.5 or 7 over here, I'll look at that. So we put that mix together. Now we do own growth stocks, but we cut way back. We're only about half invested right now. But if we've owned the stock, we've owned Microsoft. I'll give you an example. It's expensive, but we've owned it for a long time. I mean, like 20 years. Some of the people 15 years, whatever. We don't take it out, but we cut it back, that's what we do. But right now, I think if you're looking at it, you want to be defensive, and you want to be in a position where if you get a break, and we're getting it now, you have some liquidity. We're not geniuses, but some of our best years have been 87, 03, 09. And it's not because we were the smartest person in the room. It's just because we had liquidity. And if you put it to work, then you can make some money on it.
And I guess I'd be remiss if I didn't ask you about this, because you said, well, we get a lot of cash in and we're keeping a lot of it in cash. I mean, you say cash. I mean, look at the dollar. The dollar has really rallied substantially. Is it a defensive rally? We're not too sure. But before I let you go, what are your views on the dollar at current levels? Is this something that's sustainable? Or do you think that this is just, maybe it's last hurrah before the dollar, comes down?
Blake, you can find two points of view on the dollar. You've got people who think that, hey, it's headed for the worst, and there's other people think it's going to stay strong. To me, all you have to do is monitor what level of reserves are still in the dollar. I mean, if we saw reserves go from 67 or 68% of the currency reserves to say all of a sudden it's at 50, then you know you're getting selling, and it may continue. You have to watch that sort of thing. I mean, you can't use the yuan. It's only like 3% of ability to have 3% of currency, and people are wary of obviously the euro, and the yen is it's been moving around a lot. So what happens is I think the dollar, just because I think people trust it enough to say, okay, if times are tough, I'm going to stay with the dollar for the time being.
All right. And being a defensive posture that you're taking, that might not be a bad place to be in the future. So, Ted, I want to say I really enjoyed our time together. I'd love to do this again with you. And thank you for spending the time with the Trader Summit community. And how do I find out more about you? If this is the first time I'm hearing your voice, seeing your face, if they somehow missed you on every other TV outlet that does financial news, which I've seen you before, but how do they follow you specifically?
Well, the best way, Blake, is to go to oxbowadvisors.com. You'll see a lot of information there. I mean, we don't hold back, and we print our market letters. We show most of our interviews. We've got 9 or 10 books that we have written about various things in the market, and especially we do a lot of work with people after they sold companies. So we have a couple of books on that as well. But that's the best place, oxbowadvisors.com. And if you certainly come in there and there's something you want, just send an email to that and we'll take care of it.
Well, thanks for your time today, Ted. And I look forward to the next time we get to have a conversation.